So, welcome guys to Professor's Opinion. And on this video, I'll talk about quantitative easing, right? And yeah, so we'll get through the details of how it works, why it has happened very frequently in this 21st century around the world, and what are the short and long-term impacts of it. So yeah, let's get started. So what is quantitative easing, right? So the core idea, okay, one sec. So the Fed peak balance sheet was $9 trillion. That means their net assets, or I think only assets was $9 trillion. And so programs 2008 to 2022, there have been four QEs in a very short period of time, 14 years, right? And so let's keep going. So the core idea here is that it's an unconventional monetary policy where a central bank electronically creates new money to purchase large quantities of financial assets, right? Primarily government bonds and mortgage-backed securities directly from the market. So it's QE activates when conventional tools fail, right? So when interest rates hit the zero lower bound, or no one's trying to buy those bonds. So then that's the last conventional step. And after that is what comes QE, first deployed by Japan in 2001 and then globally after the 2008 crisis, right? And so, yeah, Japan is a good example because Japan was the first one to try this at a large scale in 2001. And what ended up happening there was that you had serious stagflation ever since, right? And this is basically one of the last resort a country has financially. It's like the last bullet in a gun, basically. You have to fight any financial war. And it can only be applied it so many times until it stops becoming valuable, right? It stops having any major impact, basically. So Japan, it didn't work much. In 2001, they tried it. Their economy was going through serious stagflation, but it just made things worse, right? So, and they ended up staying at very low interest rate ever since then because the economy would basically collapse if the interest rates went up. And that's where we come down to today's situation, and I'll explain that in a bit. So who does it? Major central banks, the Federal Reserve, European Central Bank, Bank of England, and Bank of Japan, each has conducted multiple rounds of QE. So it's the big banks, right? Which with established a reserve currency or established a dominant currency that is used by most countries for trade, right? And so the printing money myth, QE doesn't print physical banknotes. The Fed credits reserve accounts electronically at member banks. This expands the monetary base, but whether it reaches the real economy depends on bank lending behavior. Now, this is the interesting part, right? This is what a lot of people don't understand about QE because you're not actually printing money. What you're doing here, you're inflating existing assets that you think have a good future or a stable future, basically. So your stocks, bonds, mortgage-backed securities, which are homes, right? So what you're trying to do is you're inflating the asset value of the rich so that the rich can borrow more money from the bank as by using these higher valued assets as collateral, and then they can flood the economy with this borrowed money from the bank at 0% interest. And the idea here is rich are more likely to spend that money in a wise manner, in a productive manner, rather than if the money was directly given to each middle class or low income bank accounts, because they're not expected to spend that money in a productive manner that will benefit the economy. They're mostly going to use that credit to consume. So this is basically what happens. Okay, the central banks give a bunch of money in different manners to the rich, and then the rich decide how to spend it or not. So what ended up happening in Japan, just like what ended up happening in USA after 2021 QE, is that you have a bunch of rich people who took the inflated assets they got as a result of the QE, borrowed money against it, but they didn't spend that money back into the economy. Like they didn't create jobs using that money or create new companies or, you know, give higher wages to their employees. They didn't do that. What they did was they bought more luxury items. They bought more gold and stocks, right? That's why stocks went all-time high. So they bought more of that. And yeah, because the rich of the Western world has realized that there's not a good economic future in those countries. That's why they stopped investing in their economies, even though they got the money to invest. So what you end up happening there is that you have a significant wealth gap as a result, obviously, because the money doesn't trickle down as it's supposed to. And that's what happened in Japan. And that's what's happening in European Union, UK, Western America, like Northern America, sorry. And yeah, that's basically what's going on. Let's keep going, right? So the central bank, so how QE works, right? So the central bank creates a digital reserves. The Fed electronically credits its own account. No physical money printed. These new reserves appear on the Fed's liability ledger instantly. So any new currency that a Fed prints is a liability on its balance sheet, obviously. So they just basically increase their own liability to make the rich richer. Feds buy bonds from commercial banks and institutions, right? Because those zero interest bonds no one's gonna buy. And you need 0% for businesses to invest and borrow money. Otherwise, they're not gonna borrow money. What you end up happening like is, for example, with the AI, you have just trillions of dollars going through the same loophole of seven big tech companies. And yeah, bond prices rise, its yields fall, right? So massive bond purchases drive prices up, demand, supply, right? And banks lend more, investors chase yield elsewhere. So lower yield pushes investors into riskier assets, stocks, corporate bonds, real estate. Banks with excessive reserves are incentivized to lend to business and households. And yeah, so that's basically what happens. So four rounds of QE, right? It happened in 2008, 9, uh, 13, 21, 23. So Federal Reserve total assets, the footprint of money creation. So 2021, like I said, yeah, that was the peak, $9 trillion. They had total assets. And yeah, there was a peak in 2022 and 2014, right? You have one here and here as well, 2009. Yeah, let's keep going. So five ways QE moves the economy. So portfolio rebalance, interest rate channel, wealth effect, exchange rate channel, signaling channel. QE signals that rates will stay low, anchoring long run expectations and forward guidance. So QE programs at a glance, right? And so you have the treasuries, MBS, agency debt. in 2008, and then in 2011 you have the long-term treasuries, and then in 2014 you have the open-ended $85 billion per month, then tapering, and then 22 you have the COVID response, 120 billion per month peak, right? And yeah, it's a lot. So the QE's biggest impact is on stock market, which is equities, right? And so idea becomes riskier assets become less, seems to be less riskier when the alternative yield is less close to 0%, right? When the guaranteed bonds have 0% rate. Well, I mean, you might as well, you need growth, right? You're going through a significant currency devaluation. So the best way to hedge against that is stock because that's where you're likely to get the highest return, right? And so it's like a chain loop effect. So the dark side of the money machine, asset price inflation, wealth inequality. We talked about that inflation risk, exit difficulty, um, emerging market spillovers, QE-driven USD weakness, capital flows into developing market, create boom bust cycles, tapering QE3, caused the 2013 taper tantrum in EM currencies, bank dependency, right? Zombie banks that depend on cheap liquidity, blah, blah, blah. Um, so this is where I want to just jump in because so you have the emerging market spillovers. So if the USD goes to another serious QE, which I think it will under Trump soon, you're gonna see the emerging stock markets go at all-time high. Okay, it's just that's where you're likely to get the highest return on your investment, taking risk analysis out of the calculation. And you'll see the boom because emerging markets is where the stocks have the highest discounts right now. So quantitative easing, expansion, gas pedal, right? Central bank buys used during recession, crisis, deflation. Quantitative tightening used during inflation, overheating. Let's keep going. The verdict is, yeah, works in crisis, creates side effects, here to stay. So yeah, that's it for this one, guys. I'll come back with another video.